Welcome and good afternoon, ladies and gentlemen, and thank you for that introduction, Lisa. I'm providing with you a presentation this afternoon dealing with the expanding obligations of being a tax agent. And I think we're about the right time to now start drilling down into the requirements of the Tax Agent Services Act, or TASA, as I'll be referring to it. The reason why is because as of 1 July 2025, which is only a few short months away, we're now going to be in a situation where most small firms of registered tax agents need to have commenced their compliance of all 17 code item obligations, but in particular code item 17, which is the last code item, and the determination which falls under that code item. So here's my usual disclaimer, ladies and gentlemen. So this afternoon, what I'll be doing is just looking at code item 17, but also looking at something else called the breach reporting obligations. Now, they've been in play for the last year, and I'll go through them because they do represent a bit of a departure from the usual types of obligations of reporting breaches of other professionals or yourself. And again, I think there are a lot of tax agents out there that aren't really clear on their current or existing obligations. I then want to talk about an area which is obviously a favourite of mine, being Division 7A and also Section 109RB. And to actually talk to you about the interplay, if you like, between breach reporting under TASA and also Section 109RB. And just to, if you think about it from a practical approach, some of the exposures that might arise simply because of a breach of Division 7A and how that now overreaches into TASA. And it's quite interesting. We'll then talk about the additional obligations that supplement the code. And again, that's just to focus on the new obligations under the determination. I'll also have a bit of a closer look into the quality management systems, because the determination requires the establishment of written materials as part of any firm's quality management system. Now, you might turn around and say, look, Arthur, our professional body requires us to already have these quality management systems in place because of our adherence to APS 110. And that's fine. You might find that the determination actually requires something a little bit more. So you simply can't ignore the relevant requirements in the determination when it comes to quality management. We'll look at other relevant matters in terms of the reporting requirements to your clients under Section 45. And we'll also have a think about some of the practical examples that you might encounter in practice going forward. And again, we're not talking about some time that might occur in the far future. We're talking about something that will occur on and from 1 July of 2025. So if you're here for the first time and you're listening to these things for the first time in detail, probably a good time that you've done it, but more importantly, just you might also want to supplement whatever I say with some detailed analysis of the plentiful materials that are available and that have been available on the TPB website that have been provided by the Tax Practitioners Board to their credit. So let's proceed, ladies and gentlemen. So in a few months, for accounting firms of less than 100 employees, it will be a very important date. I say that the changes to TASA, because of responses to the conduct by, or the alleged conduct by PwC, are far-reaching and I believe quite disproportionate. The allegation is that someone from a large firm has done the wrong thing, and as a consequence of that event or connected events, all tax agents have effectively been tarred by the same brush and now must also consider a response of increased compliance, despite the fact that there was no evidence that the tax agents were doing wrong thing generally. And I'm talking now about smaller firms. But in the event, we are where we are. There are also additional changes to Code Item 17, including changes to whistleblower rules and also promoter penalty rules. So you can imagine how these alleged events that have occurred through the conduct of one firm has brought about such a varied response to a whole lot of different laws that affect tax agents going forward. So again, it's quite sad, if you like, because as if tax agents aren't busy enough running practices and doing their CPD and collecting their debts and putting food on the table, without all these additional compliance requirements, but they're there, and a failure to comply with all of these requirements is a code item breach itself. So this is not something that you can ignore. This is a non-negotiable, and you've got to stick to. So prior to 1 January 2024, we had 16 code items, and in fact, to the year prior, we only had 14 code items. We then had code items 15 and 16 dealing with disqualified entities. And then we had code item 17 coming on 1 January 2024, all as a response, if you like, to some of the perceived difficulties that were identified in the James report by Keith James and Neil Earle. And what happened was that as part of the recommendation to government that code item 17 be implemented into the law, we also had these breach reporting rules. Now, these breach reporting rules, people are saying, oh my God, we've now got to dob in on other tax agents. We've also got to dob in ourselves. Look, that's not the case. Those rules have always been there. I'm pretty sure if you look at the bylaws of your own professional organisation, and for example, I'm referring to the Chartered Accountants bylaws, you do actually have an obligation to report a breach either of yourself or of another tax agent anyway. So who's also a chartered accountant. So it seems to me as though this isn't something that's that new, except to say that now it's a statutory requirement, but more importantly, if you fail, I'm going to repeat that, if you fail to report a breach, which we'll go to shortly, it's actually you now being in breach of TASA. And the last thing you need as a tax agent is being involved with TASA, because all that happens with TASA is that you get a very long or could be potentially a long-winded investigation, and they need to do that. It can be intrusive, it can be very stressful, it can be very, very costly, and it's something that you don't need. So again, if you fall within the requirement to report a breach or a dob in, so to speak, you've really got to think about doing it and following through with it, and we'll go through that shortly. But I just wanted to say this also to finish up on this slide, ladies and gentlemen. The determination that is now part of Code Item 17 contains 8 new obligations which came into effect last year, but have been amended with the start date happening in 3 months' time. I will say this though, TASA is now a difficult piece of legislation for tax agents to work with. I think that's undeniable. When TASA was first introduced in 2009, following on from the provisions that it borrowed from the old 1936 Tax Act, it was sort of workable and it was pretty understandable. Now it's very, very difficult, unfortunately. So let's have a look at these breach reporting obligations. So just so we're clear, they're not part of the Code of Professional Conduct. They sit outside the Code in sections 30-40. And what they say is this. They say that from 1 July 2024, if you commit a breach of the Code, and the breach is a significant breach, or if you are aware of another tax agent having committed a breach of the Code, and where the breach is a significant breach, you've got to notify the TPB. A failure to notify the TPB, and I didn't say the ATO, I just said the TPB. Failure to notify the TPB within 30 days is a breach of the code. Can also be a breach of Section 8C of the Taxation Administration Act. And what that does is it allows the ATO, the Commissioner, to prosecute you, usually in the Magistrate's Court. And if you're found guilty, it's open to the Magistrate to then make a notation of a criminal record, which obviously then creates additional problems in terms of your ongoing registration as a tax agent. A notification of a breach, which is a significant breach, must be made in writing via the TPB website within 30 days, which you first have or ought to have reasonable grounds to believe that the other agent or yourself significantly breached the code. Now, you might say to me, well, Arthur, what is a significant breach? Now, let's just go back a step. I'm saying that it's all about belief, and we can discuss this later, but it's all about belief. So the word is not knowledge. So if you have grounds to believe as opposed to knowing, then that is enough. It's a lower threshold. For example, I might have faith in a higher entity, let's say, it doesn't mean I have knowledge. It just means I've got faith. I believe, and that's a very, very low threshold. So you can understand what it means now to simply form a belief, provided that it's on reasonable ground. It's not being done for the purpose of you being or wanting just to cause trouble to somebody else. Provided you've got reasonable grounds to believe there is a breach and the breach is significant, then you have a reporting obligation. Now, that means this. That means if you're a principal of a firm, you've got to make a call as to whether or not you make the breach if you believe that the breach is significant. If you're an employee of a principal, you must immediately tell your principal, and you must tell your principal of all of the circumstances that you're aware of, so to allow your principal to make an informed decision as to whether or not there is an obligation to report a significant breach. So you might turn around and say, look, Arthur, what is a significant breach of the code? Well, a significant breach by a tax agent is significant. Now, before we go any further, I don't want you to get fixated on the concept of significant as it's commonly understood. Significant to me means something beyond the norm, or something that's much larger than expected or materially. That's not the case. All a breach requires for it to be treated as being significant under TASA is that it either constitutes an indictable offence or an offence involving dishonesty. Now, you can imagine there are whole lots of offences involving dishonesty under an Australian law. And from petty theft to putting incorrect journal entries into records or incorrectly keeping records, all of those offences are offences that involve dishonesty. So if you're aware that that's occurred, sorry, I withdraw that, I've made my own mistake. If you have reasonable grounds to believe that that's occurred, then, and it's dishonest, then automatically the breach is significant. Now, an incorrect entry, you might say, Arthur, that's not significant, but the incorrect entry would be an offence under any one of a number of laws, Australian laws, and as a consequence, that one single event or that one single deficiency, if you like, or omission now becomes significant in its own right. A breach is also significant if it results or is likely to result in a material loss or damage to another entity. Now, if you think about it, if for example, a registered tax agent, I'll give you an example. If a registered tax agent who is a former employee of another registered tax agent simply takes clients and starts and commences their own business, let's just say they take away half the clients. Would that, ask yourself the question, that would result in a material loss. So if it results in a material loss, it's conduct by a tax agent that would arguably become significant. So again, it's that. It's not simply causing loss to the Commonwealth. Now, paragraph C, I think, is the one that's going to cause most breaches to become significant breaches, and that's this: is otherwise significant, including taking into account any one or more of the following. So when it refers to any one, it's any one of the following subparagraphs: the number or frequency of similar breaches by the agent, the impact of the breach on the agent's ability to provide tax agent services, and the extent to which the breach indicates that the agent's arrangements to comply with the code are inaccurate. So think about this. If you're a practitioner, and unfortunately with the complexity of our laws, you are unaware about the way in which a law operates or is intended to operate, and you continue making the same error over and over again, all of a sudden you've got breaches, the number or frequency suggest that you aren't able to provide a competent service, which means that you can't comply with the code. All of a sudden, we are now in significant breach territory. So if we go to the next slide as an example, you become aware that a competitor tax agent practice that promotes itself as obtaining the highest possible tax refunds regularly and systemically claims work-related reductions for $300 for taxpayer clients who have not incurred any relevant expenditure, have not sought to claim the deduction, nor even aware the deduction has been claimed. Now, just think about that and ask yourself the question: is that a breach that's a significant breach? So what you've got to do is ask yourself the question: is it otherwise significant, taking into account the fact that it occurs across all of the clients of the firm? In other words, it's a systemic issue, and it's the extent to which the breach indicates that the agent itself can't comply with the code. So it shows that the agent, in claiming deductions in cases where the clients aren't even aware of it, and the usual information might be, oh, well, the law allows you to claim an amount without necessarily needing to be substantiated. So as a consequence, and that's a $300 limit. So let's just claim $300. That of itself, across one or more clients, would indicate that the agent is acting without integrity and dishonestly. And as a consequence, we're already in a breach situation, which is a significant breach. So the point of the exercise is this: any one or more errors or things that are occurring with the tax agent's practice that aren't correct could of themselves constitute a Division 7A breach. So you can imagine, for example, and again, I go back to Division 7A, if a firm commits common errors relating to Division 7A and you become aware of it, or at least believe that it's occurred, you would have to ask yourself, is it significant? In other words, is it such a broad error across the firm as a whole that it shows that the tax agent can't provide a competent service? On that basis, you would have to form the view that it's a significant breach, and as a consequence, you now have reporting obligations. Now let's look at 109RB. And again, the reason why I want to look at this quickly is just to show you how easy it is to move from the tax law, the substantive tax law, into TASA. Now remember, the substantive tax law looks after taxpayers. TASA looks after tax agents. So Section 109RB, we know that is the section in Division 7A within which the Commission has the ability to ignore the operation of Division 7A where there has been an honest mistake or an inadvertent omission, and the taxpayer satisfies other issues as well. So I think we should all be relatively sure about the way in which 109RB applies. You've got to make an application to the Commissioner to say, look, hey, this has happened. It's given rise to Division 7A. Please ignore it because this is the corrective action we're going to put in place. And we're going to do these following things, which the Commissioner agrees with. And as a consequence of following the things by the timeline set out by the Commissioner, Division 7A won't apply. But at least it'll put you back in the situation, or the position where you would have been, your client would have been, had the error not occurred. Now, let's look at a client that you're considering bringing on board. Let's just say that you've found a Division 7A issue, and let's just say it's as simple as a miscalculation of the minimum yearly repayment, only because the tax agent, the current tax agent, simply can't calculate Division 7A correctly and calculate the minimum yearly repayments. You have to ask yourself the question, is that an error that's also committed for other clients? Now, you might choose to stop the investigation there, but if somehow, let's just say that you've received or you've taken on other clients from the same tax agent with similar issues, you can now reasonably form a belief that it's a systemic issue within the firm. And as a consequence, you now have an obligation to report the breach to the TPB within 30 days. Now, the TPB is obligated to pass on that information to the ATO, and it means that the prospective client and other clients of the agent could be audited, in addition to sanctions imposed imposed upon the other agent by the TPB. So again, let me just encapsulate that before we move on. If you are getting a client from another agent where you can immediately identify issues and there isn't a proper explanation provided for those issues, you immediately have to ask yourself the question, is this a problem with the tax agent? Now, if there are other things that you are aware of that lead you to provide or to get reasonable, to reasonably believe that there are other errors, then you can form the view that there is now a significant breach. If there is a significant breach, as it's defined in the previous slide, you have an immediate reporting obligation to tell the Commission, to tell the TPB. So it really is a very important tool, if you like, that the TPB has under TASA in order to make sure that people are doing the right thing. So and again, another thing about Section 30-40 is that not only do you have to advise the TPB It's also necessary under the same section, if you are aware of the other tax agent's professional body, that you also notify that body in writing as well within 30 days of forming the belief. So I would hate to think that there are tax agents out there that are aware of significant breaches, but they choose to do nothing out of embarrassment or out of a whole of other different requirements. And then they get investigated for the same issue because, for example, the TPB might have spoken to the client and the client might have said they spoke to you. If the question is put to you, well, did you form a particular view? If you didn't, why didn't you? But if you did, why didn't you report it? It puts you in a very, very difficult position. So I've adopted the view that when I speak to my clients about Section 30-40 and the breach of reporting obligations, I say that when in doubt, report. If you've got reasonable grounds to believe that a breach is a significant breach, just report it. It's not embarrassing. What it is you complying with the law, and it really is necessary. And I hate to say this, but you might need to obtain legal advice. In fact, I think it would be prudent to obtain legal advice to ensure that, number one, you're satisfied that there is a breach. Number two, that the breach is significant. Number three, that there's now an extant reporting obligation. Let's move on. So we now have the additional items under the termination. And these additional items are as follows. Section 10, this is what I call low-hanging fruit. It's just basically that you can't do anything now that might be seen as undermining public trust and confidence in the integrity of the tax system or the profession, or bringing the profession into disrepute. That's no different to the wording in other codes or legislation that deal with other professionals in different professions. Us lawyers have it. I know architects have got it. Medical practitioners have got it. So you can't do anything that brings the profession into disrepute. A problem area that's been identified, if you like, is Section 15, which deals with materially false and misleading statements, either by you as an agent or by somebody else that finds its way into a return that's lodged with the ATO. Now, I'll discuss that in more detail below because it needs some further discussion. Point being that, again, this is really important that you really do come to grips with the requirement to deal with materially false and misleading statements. Section 20 says that if you act for an Australian government agency in a professional capacity, you must disclose any conflicts of interest. Section 25 says that if you receive anything from an Australian government agency, you can't do what's been alleged to have occurred by the other practitioners in the other firm. In other words, if you get information in confidence, keep it in confidence, and it stops there. That, of course, is limited to reasonable carve-outs, such as, for example, where the information, for example, is already in the public domain. Section 30, I think, is something that shouldn't be new to tax agents, but it's now a requirement that all records that have arisen in an engagement with a client must be kept by the tax agent for a period of 5 years and provided to the ATO or TPB when necessary, subject, of course, to any claims for legal professional privilege. In the past, and I've also practiced as a tax agent as well, in the past, what would happen is when a client would leave you, and assuming, of course, there was no express term in an engagement letter, but if a client left, they'd say, look, make sure you destroy everything or give it back to me. I don't want you to have anything at all to do with me. No trace at all about me or my company or my business or whatever. And most tax agents willingly did that because as far as they were concerned, there was less information to hold and it was just, it was suitable all around. Now, that can't occur. So even if you get a demand from a departing client that everything must be destroyed, you must say that, no, I cannot, and I must retain it for 5 years, and I must divulge it if necessary. So two things come from that. Number one, your engagement letters should be amended. And I would, just on that particular point, I would suggest that all engagement letters now are amended for a whole lot of different reasons in a whole lot of different ways. The second thing also is that if you are in fact required to give information as a request, let's just say that it comes as a consequence of a warrant issued by a court, or just simply someone purporting to exercise a power to retrieve documents, you probably need to get legal advice fairly quickly about whether or not you can divulge anything. So, for example, if you get a 353-10 notice, you are compelled to divulge. But again, you should always advise your client that you receive, or your ex-client, that you receive this information, and giving them the chance to address the issue as well directly, rather than you just simply giving information, although that might necessarily be the case. Section 35. You must ensure that each entity providing tax agent services on your behalf maintains knowledge and skills that are relevant to the tax agent services the entity is providing and is appropriately supervised. Now, I just want to stop there. There's already a code item that deals with supervision of others providing services on your behalf. This takes it one step further. If you, for example, were to retain me as a lawyer to provide legal advice, you're doing it on the basis that I'm an accredited specialist and I've got the requisite skills and experience in order to provide you the advice. Section 35 says, number one, you've got to make sure that I know what I'm doing and I know what I'm saying. You just simply can't take what I say and just rely on it simply because I'm a lawyer with a PR policy. Secondly, you must also appropriately supervise me. And I don't know how that's going to occur, but think about it in two contexts. Number one, I'm offshoring or using offshore services. I think this is going to be a real problem area and an area of real concern by the TPB in the future. I think that the TPB is going to say to a whole lot of practices that are using offshoring services, how are you appropriately supervising the people on the ground in, say, Asia, where most of the services are being provided on your behalf? And you need to have a pretty good response. It's getting to the stage now where firms that are using these dedicated support services overseas are actually having local people on the ground in Asia or wherever the services are being, or Southeast Asia, or wherever the services are being provided, supervising those services. Now, you might say, Arthur, that's not appropriate for small firms, and I would agree. So that's why I think a lot of these overseas firms are also going to go down the path of trying to become registered as well. But the point is this, the point is you simply can't offshore and do nothing else and just get back a finalised product. There has to be appropriate supervision steps being put in place. So again, that's something that's going to catch out a lot of tax agents. Similarly, you can't really use the service of it, and I'm not denigrating anybody here. What I'm saying is this, you simply can't go to a small local solicitor who, for example, might specialise in conveyancing and ask them for a very, very technical question about Division 855, if you like, of the Income Tax Assessment Act. They're just not going to be equipped to provide that type of information and advice. So it's incumbent upon you to make sure that the people that you're getting advice from are able to provide the advice. For example, I'm no good at providing advice relating to transfer pricing, sort of, or more importantly, dealing with R&D concessions. It's not my job to sit there and pick apart P&Ls to determine what costs are development costs and so on and so forth. So again, it's necessary, if you use anybody else's services to allow you to do your job, you've got to supervise them and make sure that the information you're being provided is correct. Section 40, which we'll talk about also shortly in a bit more detail. You must establish and maintain a system of quality management in relation to the provision of tax agent services by you or on your behalf, which is designed to provide you with reasonable confidence that you are complying with the code. Now, that's different to the usual requirements of having quality control documentation in place, because that quality control documentation really looks at the quality of the service provided to your client or the consumer. This is different. This asks the question, does your quality management documentation allow you to comply with the code? So again, it's just something that you just really need to stay on top of, and we'll just talk about that shortly in a moment. It also says that you must document and enforce the policies and procedures of your system of quality management. So one of the questions that the TPB usually asks when they're conducting an investigation is, please provide us with a copy of all of your written documentation, as well as your policies, as well as evidence that you have enforced the policies. And a lot of people, particularly tax agents who are quite busy, just tend to have the documentation, but if it's in physical form, they just simply keep it in a desk or a drawer where it gathers dust. The TPB does rely a lot, as do your professional bodies, do rely a lot on the fact that you must have quality control information, documentation in place, and that it is effectively what's known as a living document. In other words, you look at it regularly, you tweak it, or you modify it, or you amend it to make sure that it's keeping up to pace and up to date with your practice and the way your practice is going. Section 45 is your client reporting obligations, and it now says this. It says you must advise all current and prospective clients. So current clients, we know we can contact by email. Prospective clients are those obviously that have reached out and wanting to become clients, and they all need to be told about the following. They need to be told about prescribed matters, and those prescribed matters are things where in the last 5 years certain events have occurred, such as being suspended or cautioned or anything like that, or even being bankrupt. Some general information. Now, that general information talks about things that that relate to obligations from you to a client and what you expect a client to give back to you. You also need to tell a client that the board maintains a register and how the register can be accessed to search for a tax agent. You must also advise the client that they can make formal complaints about you to the board. It says that your notification must be in writing, prominent, clear and unambiguous way when onboarding a new client, or if a client inquires about retaining your services, or within 30 days of becoming aware of the matter. So it might be the case, for example, that you've received a sanction as a consequence of an investigation from the TPB. You have to notify all of your clients within 30 days in writing about what's occurred. And again, this is something now that tax agents are going to have to be on top of in order to ensure that where an event occurs that needs to be notified is in fact notified. Because if not, again, it becomes a breach of the code, and that's the last thing you need. Let's move on. So, Section 45, to avoid breaching the code, the requirements now require you to disclose, in addition to sending an email, leaving it on your website in a prominent way, as well as in your engagement letters too. So again, your engagement letters now are going to have to talk about events that have occurred where they need to be told to your clients. Now, you might say, well, this all happens after 1 July 2025, so we only have to worry about events that have occurred after that date. And the answer is no. It also applies to matters that have occurred after 1 July 2022 as well. So again, a lot of work needs to happen. Now, remember a few months ago, I spoke to you about the false and misleading statements. So let me encapsulate that in as brief way as possible. You're going to get a copy of these slides. So I would urge you to just keep them handy, but I will try and distill, if you like, the essence of what they say. The first thing is this. Number one, you as a tax agent must not make a statement to the TPB or to the ATO if you know the statement is false or misleading in a material particular. It stops there. So if you make the statement that's false or misleading in a material particular, that's the first problem. The second problem is you can't allow somebody to make a statement that is false or misleading in a material particular in a document that you lodge. So, for example, you can't have a client that says to you, I run a cash business and I only made $10,000 when you ought to reasonably know that it is materially false and that the number is a much larger number. So just so we're clear, it's a false and misleading statement in material particular that you make or somebody else makes that goes through you to the ATO. So that, if you like, is the basis or sets the foundation of the prohibition. Now, again, I apologise for the font here, but it goes something like this. I said that a false and misleading statement or material particular, if it's made by you then you must fix it. If you allow a false misleading statement of material particular to be made through you to the ATO, where you believe that the statement was false and misleading and it was material, that it was made in circumstances where it was either done with a failure to take reasonable care, or that it was reckless, or that there was an intentional disregard of a tax law, these are the things you need to do. So again, I need to say that it's a false or misleading statement in a material particular in circumstances where the statement through you was made with either a failure to take reasonable care, reckless, or intentional disregard. So that's wording that comes from the penalty provisions as well. So here's the thing, ladies and gentlemen, this is where we get to the nitty-gritty. If you make a false misleading statement in material particular, you've got to fix it. It stops. It doesn't matter. And that can occur when you're writing to the ATO and you're making a statement on behalf of a client, or you're saying something to the ATO about a client, and you get it wrong, you've got to fix it. It doesn't matter what the client says. You've got to fix it. Where, however, you make a statement or a statement is made through you, such as a tax return being prepared by your firm, that goes to the ATO, that you later find out contains a statement that's false and misleading in material particular, this is what you've got to do. If the statement was made in circumstances, I'll withdraw that. If you are aware that a false misleading statement was made in material particular, you've got to get the client in, you've got to tell the client, hey, you've got to fix it. And you've got to tell your client about the consequences of not fixing it. And the consequences usually are that if you're detected by the ATO, you've got to repay the primary tax and penalties and interest as well. Now, let's assume you've done that and you've said that to your client, and within a reasonable period of time, which is 30 days by the TPB, your client has failed to have the error rectified. Okay? So let me just repeat what I just said. You've got to tell your client about the error and that they've got to fix it, and what happens if they don't fix it. If after 30 days your client doesn't fix it, and the statement was made in circumstances where it was reckless or an intentional disregard of the law, you have to disengage. And as much as I don't like saying that, it's something that you need to do. You must seriously think about terminating the relationship. Now, again, your engagement letter's got to say that there might be circumstances where you can unilaterally terminate the retainer, and that might be for things such as just cause, or, for example, where there's a breach of the code that you've committed, or that you don't, or that you might choose. That you might be committing. But again, it goes back to the engagement letter as well, the ability to unilaterally terminate on your behalf. There might be occasions where a false and misleading statement of material particular is causing loss to third parties, such as employees, creditors, investors, and so forth. If that's the case and you're aware of it, you need then, you do not disengage. You must then report both to the ATO and the TPB. So what I've done there, and look, I haven't made this up. This is just simply a cut and paste from the legislation, but it just simply says that these are the things you've got to do, and when you've got to do them. For example, as I said before, if a statement's been made that hasn't been rectified by the commissioner, where the statement is made recklessly or with an intention to disregard the law, you have to withdraw from the engagement and the professional relationship. So again, it's really, really difficult. There's only a couple of carve-outs where you don't have to make these you don't have to do the reporting. And that's, for example, if the reporting might cause or pose an unreasonable risk to your personal safety or those of your employees or family. So you can imagine how it is going to be a case where I think a lot of people are now going to have to pay particular attention, and not just to the time when returns are prepared and lodged, but even years later, if something comes to their attention that something needs to be rectified, then they're going to have a very, very difficult discussion with their client to the point where they might take the view that they might need to disengage. And again, the usual case is when, for example, the issues involved, for example, run into things like, for example, cash businesses and so forth. And it's not just simply, it's not enough now for a tax agent to turn a blind eye. Never has been, but now in particular, it's going to cause tax agents to have some real issues about what they do going forward with their with their engagement with their clients. Let's have a talk now about quality management systems in Section 40. You should already have similar systems in place under APS 320. The purpose of maintaining the system of quality management is just basically, it has to provide you with a reasonable confidence that you're complying with the code. And again, going back to APS 320, you need to ensure compliance with the code. The documentation that you have in place must address each of the following. Number one, who's responsible for the overall quality within the firm to make sure that there's a consistent service provided to all clients. Number two, how ethical requirements are monitored and addressed. Number three, how you onboard client relationships and specific engagements. Number four, how internal human resource issues comply with all state and federal laws. Number five, how to make sure that work is done consistently, accurately, on time and within budget. So again, there's no point in saying, oh, look, I'll ignore that, or I'll just drag it down something from the internet and just tailor it a bit to suit my circumstances. No, it's got to show that it's been prepared and relates directly and consistently with your firm. As I said earlier about the issues involving what's necessary to keep your clients informed, an agent must advise all current and prospective clients of prescribed matters and general information. The prescribed matters are set out and have got a 5-year time limit. And the factors that you need to advise your clients of and prospective clients are prior suspension or termination of registration, bankruptcy, convicted of serious tax offences, imprisonment, and sanction because of involvement in tax exploitation scheme, unlikely to involve most, if not all, registered tax agents. So let's now have, in wrapping up, let's now have a look at some common grey areas. Breach reporting is going to be very difficult to deal with in future on a practical basis. You're going to have belief, and the belief itself is going to have to allow you to form the view that a breach is significant. So again, it's going to be difficult, and the best thing to deal with that is to ensure that in your engagement letters you spell it out to your client that if I form the belief that somebody else is doing the wrong thing because of me looking after your work, I might need to get legal advice, and I might ask you to contribute to those costs. So it's a real issue there that you need to think about. And again, have a think about your engagement letter, the current engagement letter, and the fact that it might need to be amended. Have a look at when you're onboarding a new client, and if you detect errors that you believe at the time might be errors that are such that they're systemic within the other agent's firm, which now treats those errors as a breach that's a significant breach. Think about Section 10 and the requirement to uphold and promote ethical standards of the tax profession. Almost anything could be a breach of that. So just be aware, everything you do and every decision that you make relating to your profession and your practice must always take into account this requirement. Am I doing the right thing by the profession? Now, you might say, Arthur, that's nonsense, but it is the truth. Whenever you go to a discussion group or whenever you are in the presence of others, always think about what you're doing and what you're saying in terms of upholding the standards of the profession. There's going to be, as I've just explained, there's going to be occasions where there's going to be a false and misleading statement of material particular. And again, that needs to be looked at as well and always thought about. Keeping client records for 5 years. There will be those clients that will object. It's unfortunate that you can no longer accommodate their requests for the destruction of all of their records. They need that spelt out. It needs to be in the first engagement letter. You need to tell them, hey, I need to keep your records for 5 years. If this causes a problem for you, maybe we need to have a think about you moving on somewhere else. And again, my final point, ladies and gentlemen, because I know a lot of smaller firms use it these days, and that is outsourcing and remote supervisory arrangements. It is likely to become a key issue with the TB in the fullness of time, and it just requires supervision. I recently had a matter involving information that was intercepted over email from one entity to another, where the other entity was offshore and it was sensitive client information. And all of a sudden I thought to myself, well, if this was tax related, it would be something that would be a breach of the code and a breach of the law itself. So again, it's really easy now to fall foul of the code. And again, if you fall foul of the code by being in breach of any one of the 17 code items, you can expect a communication from the TPB commencing an investigation. So on that note, I think I'll wrap it up there. I think I'm just on time too, Lisa. So they're my details there. Please feel free to give me a call if you've got a question or a query. I am finding myself now doing a lot of work in the TASA space, and there's not that many people out there that are doing work in this space. It's very interesting, and because I've also worked as a tax agent and being a registered tax agent myself, I know what most registered tax agents go through from small firms. So on that note, thank you very much indeed for your time and attention this afternoon, and I look forward to talking to you in due course.